Welcome to ECN Trade Daily Video. Before we begin, it should be noted that any advice is of a general nature only, and that your personal circumstances have not been taken into consideration.
Hello everyone, my name is Rob Clayton and thank you for joining me. On Monday, the Australian dollar's risk sentiment remains bullish after making a modest gains against a weaker US dollar, as traders adjust their positions ahead of the Federal Reserve's monetary policy decision on May the 1st, or Thursday Sydney time at 4 a.m. In today's economic data, according to the Australian Bureau of Statistics, the ABS, Australian retail turnover fell by negative 0.4% seasonally adjusted in March. This decline followed by a 0.2% increase in February and a 1% rise in January. Sales of household goods, clothing, department stores, other retailing and cafes decreased in March while food retailing increased. On a yearly basis, retail sales experienced a 0.8% rise. Investors are now preparing for the employment cost data in the US, along with that with the JOLTS job opening figures, the ADP's National Employment Report, and the Labour Department's non-farm payrolls report for April. All these are scheduled over the coming days. Turning to the technicals though, we can see since the break of the 60-day moving average has supported now to a target of 66 to 67 cents, though the given weaker retail sales has put a bit of a dampener on the rally, but due to the overbought conditions has now put it in a better position or prime position for the bulls to return and see a further rally. Weakness on the day expected to find support around 64.65 to 65.20. The euro dollar saw a slight increase against the US dollar, as mentioned, experienced a minor retreat from the 5-month highs to 105.65 this morning. Investors are shifting their focus to a crucial week highlighted by the jobs data in the US and also the upcoming US Federal Reserve rate decision. Traders eagerly await any hint about future rate cuts, although forecasts won't be provided in the statement this week. Fed Chair Powell may offer some insight, though, during his press conference after the announcement, but recent high inflation and strong economic indicators have shifted market expectations for the first rate cut, which has now been shifted from June out to September, which now may be even further to December, given the proximity to the November's US presidential election. This week's US job data, or the non-farm payrolls, will also heavily influence future forecasts. As the pattern slowly climbs and the indicators are holding somewhat positive, should see a further upside move to 107.40 to 107.8090. I do feel that we will probably negate this outside range day and therefore put the bullish bias on its stride, and any pullback likely to find support around 106.8085. A very whipsaw price action when it comes to the dollar yen after surging above 160 and reaches its highest level since 1990 on Monday, as speculations arose that the Bank of Japan might have intervened in the currency markets for the first time in 18 months, causing the Japanese yen to spike as much as 5 yen against the US dollar. Japan's top currency diplomats declined to comment on whether the authorities had intervened. While also turning to this week's economic data, the market is still very much focused on the US Fed and also the non-farm payrolls. Following Monday's price action, we now have an engulfing Japanese candlestick that does suggest a potential bearish reversal. However, we do need to see a close under 155.50 to support this case. We did stab at it yesterday, but did not close under it. But given the technicals breaking down and the bearish engulfing candle does support further downside risk, with 155 broken, could expose the region onto 153 down to 151.5. While viewing the top side, little is assessed, and therefore I'd rather keep to a neutral bias. After an engulfing candle from sterling, the market has negated this pattern as it pushes higher overnight and now potentially clearing 124.8090 puts it on a bumpy path to 126.25 to 126.70. Any weakness should find support around 125.25. Little can be said so far for gold as it keeps to a sideways pattern in 5 consecutive days, but the technicals are negative along with the MACD and the RSI, therefore should keep the bearishness in play, at least towards the region of 2,300, Reassess from there, as we could see a further move down to 2,250. Conversely, a break above the level of 2,337 could signal upward momentum, prompting reassessment. Wrapping up with oil, the market is still maintained somewhat bearish and looks towards these two key levels seen at 80.50.75 and 78.55.85. But we do need to see a break of 80.5 to support the bearish case further, but the technicals are heavy, which should limit the upside around 83.5 and a cap seen at 84.20.40. Well, that's a wrap. Thank you for joining me, and as always, look out for the interest rate report, and I hope you enjoy the great start to the day.